Hello and welcome to another episode of the Stock Market Today video. It's Justin Nielsen here, and man, what a week we had. Growth coming back on strong. So ending October, which had a lot of tricks in it, with a little bit of a treat for investors. Helping to break it down, the action for today and this entire week is Mike Webster, our senior market strategist. How you doing, Webby?
Good, man. I'm ready to put October to bed. It was a tricky
Yes.
month for me, just to be frank, man. So I know we're at new highs and everything, but man, I got tricked a few times along the way. So I'm looking forward to November and December.
Yeah, I'm with you. The strategy that I was trying, where you buy at highs and sell at lows, just didn't really seem to work for my portfolio. But hey, you live and you learn, right? So that's
Yep.
yeah, I shouldn't try that. But yeah, our I think on Thursday, one of the things I was saying for that day at least was, wake me up when October ends was kind of the talking point there. Of course, we will
So you were
cover.
looking for a green day to end on?
I was looking for a green day exactly to end things. We'll cover a few stocks, including Amazon, which had some great earnings. Cloudflare, NET, and also Hood, which I do have a position in Hood. That's Robinhood, of course, the brokerage. And first, let's take
And
a
I
look
have
at the
positions in
markets.
all three of those, I just have to say.
Yes, you do, in all your splendid glory. So let's go ahead. I'm going to share my screen. We'll bring this up and we'll go through the markets real quick. Starting with the Nasdaq. Looks like the Nasdaq ended up. Up for the day, but kind of some stalling action. It was up 0.6%, finishing in the lower part of the range at about 30% range, closing range. The S&P 500 that finished up 0.26, also around the 40% range. Really opened up very strong, and so like the Nasdaq was actually off almost 0.9% from its high. SPY about 6 tenths of a percent off of its high. The Dow Jones Industrial Average that ended up 0.09, but at least that was in the upper half of its range to finish up. And the Russell 2000, I'm going to pull up IWM here, which is a ETF that covers that. That was up 0.7%, and this one was actually up in the upper part of its range. We're also going to probably talk a little bit about the breadth issue. Invesco S&P 500 equal weighted ETF that was up in the top part of its range as well, finishing maybe about 66% range with a 0.22% gain. And one of the stocks we were talking, or one of the ETFs we were talking about, is MDY, the mid caps. This is also still below its 200-day moving average line, but finished near the top of its range, trying to make a little bit of a comeback. So let's go back to either the
And that was
Qs or the Nasdaq.
below the 50, but above the 200. I
Yeah.
think that's what you meant to say.
Oh, what? Yeah, I know I said below the
Maybe
50.
I heard something
Yeah.
different. It's Friday and all,
Right,
I
exactly.
can
We're
be
ready.
hearing things.
Let's go ahead and go back to the Nasdaq Composite, and I'm gonna throw up a weekly chart here real quick because certainly last week we were talking about how you really couldn't have asked for a better candle, a better looking bar, and it was nice to see a very strong follow up to that. I mean, that's kind of what you would expect, but maybe was this even stronger than you expected?
Yeah, so last Friday, and if people miss the show, I would go back after the show. No need to leave now, but after the show, I would go back to last Friday's and fast forward to the end of the show because we went through some precedents. Let's go back to the daily for a second, where we were looking at the two of us were looking at days like that big spread. I think it was October 10th, where you have a really big distance between your high and your low. And then when you stayed within those for a number of days, that when it was like 5 days or 6 days, sometimes you would have head fakes where you would go up and then come back in. But then once you got out to 7 or more days, the data was really, if you whichever direction you went in first was the direction you continued in. And so, meaning if we would have broken down below the October 10th low, we would have expected maybe a trip down, near the 200-day, the black line, or with a move up for to move up and stay up. And that's what happened. It's just, frankly, it was kind of hard to believe that this would happen this strong, like this big of a move. But we are really in a news environment We'll talk about the Fed in a little bit, but there's obviously the biggest news besides the earning season that we're in the middle of is everything that's going on between the U.S. and China, and there's so many news things, with the government shutdown and all. You always have news items, but it seems like right now they're a bit bigger, but than normal,
But
and
don't they always feel bigger when they're happening? you know?
every single time, Justin.
Right?
And then
Yeah.
what happens is out from a year from now, you'll be like, what were you even worried
Yeah.
about that news
You,
item?
you
There's
won't even
always something to
remember.
worry about.
Yeah, I mean,
Yeah.
like even the other day, someone was asking, "Hey, what happened this January 27th where things fell apart?" And it was like DeepSeek. That seemed like the most important thing ever. How could you ever forget? And now it's like, what was that January 27th? So
Well,
yeah,
think about the bear market that we had, which was significant. I know everyone brushes it off like it was just a blip and just buy the dip and all that silliness, frankly. That was a bear market, and bear markets normally don't end like that. We have, a history of two of them, the COVID one and this one. So everyone is who hasn't studied history thinks, oh, this is just what happens. You just hold your stocks, even if they fall apart, they come right back. Study history, study 1929. By the way, the book that Andrew Russ Sorkin has out on 1929, I'm almost done with it. That guy has done a fabulous job with that book. It's so, maybe it's because he's got a lot of Livermore in there, and I'm such a Livermore fan that's why
right.
I'm digging it. But it is really well done. If I ever write or when I write a book, if I can even get it a tenth as good as what he's done, it's just excellent. But 1929, 2000, 2007, 1973, 1974, and so on. 1907. Like there are these times where, well, 1907 wouldn't be a good example, but the other ones would be that you just don't bounce right back the way we did. So you need to be protecting your account when you start seeing signs of rolling over. Like the October 10th was, I know everyone who didn't sell on that day is just saying, oh, well, it was just a blip. That's how they look before they start going down and undercutting the 50-day. We just got lucky with news, man. And so if you get lucky, just realize you got lucky. You can get unlucky as well. But think back to that bear market. That was all about the worry about these tariffs. That was a big news. We didn't know how to digest that news, and it took the market coming off, over 20% for us for the market to be able to price it in. So no matter how big the news is, the market eventually will price it in, and then say, "Oh, it's really a nothing burger, or actually maybe a net positive based on what the market's done, since the news of the tariffs." It's a net positive. That's the way the market's interpreting it because it was at 14,000. Now it's at 24,000, give or
Right.
take.
And now I want to also point out because we were talking a lot about this December 18th day. This was,
Hmm.
a reaction to Fed comments. It's not that the Fed action was a surprise that day, but the commentary afterwards is what kind of threw the market. But when we were looking for these precedents, one of the days. It's not quite as doesn't quite stick out as much, but one of the days that we were looking at was this day right here. So to your
Hmm.
point, October 10th, while you can say, oh well, look, you didn't need to do anything because it came right back. Well, if you had taken that same same idea or same tact there, you were looking at a very steep drawdown. And again, would you have really wanted to just bury your head in the sand through that whole thing? You could, but it gives you a larger drawdown than is absolutely necessary to take. And I personally am not a big fan of drawdowns. I know that they're a part of the game, but anything I can do to reduce my drawdown, especially as we're getting on in years, is something that's important to me. Do you want
Yeah.
to move
Well,
over to
but
SPY? Oh yeah.
before we do that, I just want to say one thing for folks to do, especially, and even if you've been doing this for decades, this is something I do all the time. Every few months, I'll do this. Is just do a change that you don't have to do this. Do a change date to the end of the year, to the end of December, and go back to the very beginning of the database that we have, and then just study it in just each year, 1 year at a time. It's also helpful to just print them out off if anyone still has a printer at home. Print it off, mark it up, and then look at what does the market look like before it goes into a correction, intermediate correction, or bear market, and what does it look like when it comes back through? And because what happens with bull markets, especially bull markets like this, I'm just really uh, scared for people because people are just being like, oh, just any warning signs, just ignore them. We're in a bull market. It's just going to keep going up, you know, forever. Go back, even study the 90s. They didn't just go straight up. And you don't want to have your gas pedal firmly down the entire time. You've got to put on the brakes. You got to put it in first gear at times. Otherwise, you're going to get caught in a 2007 to 2009 or a 2000 to 2002 and so on, or even a 1998, 33% bear market in the
Yeah.
blink of an eye. You've got to pay attention because people are really, and you remember what Bill would say during the bear market of 2000 and 2002. He would say, this is great because you are
Hmm.
learning all the things not to do to make sure that when you get another bull market that you've got all those bad habits that are worked out, because you get a lot of we got all of us got a lot of bad habits in the 90s because it was, you know everything would just keep coming back eventually, and then you have to resolve that. So look
Well,
at
here I was a 23-year-old kid just starting out, and all the analysts with these fancy Ivy League degrees were saying, "Hey, buy Yahoo on the dip, buy Cisco on the dip, and that's all you have to do, and you've solved the market." It's just that easy,
exactly, and
which
folks
was
should go back and study those.
working great until it didn't, and then
Yeah.
Cisco went to one. So,
Yeah, so there's probably some balance in there. Like for me, frankly, I probably pay too much attention to the noise and would do a better job if like would take a step back and then, wait for the 21 day to crack like it did on the 10th and then take action. And I think I'm a little bit too proactive, and so is Bill O'Neill, the founder of IBD. And I guess it is what it is. There's it's a balance type of thing. But anyways,
mhm,
we can go over to SPY and look at the difference between SPY and RSP because that's very
yeah,
important. This one obviously not as strong as Nasdaq, but very close, and it broke out above that trading range that we had that I really frankly thought was going to be a lot longer sideways. But the news flow was such that we moved back up. So now we've got a line in the sand that is raised up. So you can kind of push it a little bit more now, as long as if it goes back below that marked high, the 673.95, that you are indeed going to back away and dial things back, because you never know. Then it could be a trip down to the 50-day or lower. But right now is what, we might as well go there. Let's go to, I was going to do this later in the show. Let's go to the Nasdaq and go back to 1999, because this is an important thing for everyone to remember. So this is 1999 was a lot choppier the first half than folks think. They always think, oh, it was just a bubble and went straight up. Look at each day and the volatility, and when you get a chance, do a track price on there and see the big swings in there. Um, but at this point, let's say you had been kicked out of the market during that move underneath the 50-day, which would have been totally reasonable, because it looked like it was going to test the 200-day. Um, and then you were defensive. Well, if you're defensive at that point, which is totally fine, as it comes back through the 50 and and the 21-day, you need to start putting on the gas. And let's just advance
and
through
this was
what
a
ends.
follow-through day,
Yep,
as well, by the way.
yep, exactly. Thanks for pointing that out. And you have to be very flexible, and that's what Bill O'Neill was, and that's who we all learn from, is that he was very bearish. Was it August that he was extremely bearish, that he wrote that
September. Yeah, I started working
September?
for him in September of '99. So yeah. Hmm.
Okay, so there in September he wrote. Well, you tell folks to
Yeah,
what
he
did he
just he
wrote?
just wrote to the clients. I mean, 500 clients, institutional, the Fidelities, American funds, and everything of the world, and how bearish he was, and how he thought we needed to have a pretty severe, uh, correction to kind of get some of the excesses out. And he was right. It was just early,
Yeah,
by a few
like
months.
everyone was. Yeah. So
And he didn't stick with it because as bearish as he was in here, when this follow through day happened, he was back to buying.
Exactly, and that's the model that we take. We don't try to predict, we interpret and adjust. So let's just go forward one day at a time on here, and the you can just keep advancing as we talk. And with this, just think back, if you froze up and you didn't buy and you didn't start getting in, you'd be saying, I'm waiting for a fall, or I'm waiting for a pullback. I'm waiting for a pullback to the 10-day, or I'm waiting for a pullback to the 21-day, or I'm waiting for a 5% pullback and an upside reversal, rather than just slowly starting to get more exposed. You're missing out on this entire thing. And what's likely to happen is, keep going all the way into January, that if you didn't have that pullback, when you finally get that thrust up, you're going to capitulate and just say, just buy me in at this point up here. And then what eventually then does happen is you do get that pullback that you had been waiting for. Yeah, on that day is when you would have probably capitulated and bought, because they happen in reverse on the way down. And then
And
look at
this is
that,
when
down
Qualcomm,
5%.
Qualcomm had its climax, topped the day before and was down very sharply the next day. So, um,
Yeah,
yeah,
similar to like RCA topping before the rest of the market topped in 29. But
in 1929, right?
yeah, and so let's go forward to, let's just do April of 2000 for people who don't have this fresh in your mind. And point back to the October when that started. I mean, you really want to get exposed there if you had gotten light the way I'd gotten, because this could happen. I'm not saying it's going to happen, but it certainly could. Like, it's set up to do that because we have the same type of environment that we had. And I'm not saying that then if we go up for 3, 4, 5 months that then we're done and we're going to have this terrible bear market. I'm not saying that at all. Just saying history repeats itself, and you could have a move up like this, or even a milder move up, and you want to be able to participate even if you got defensive. So just go back and study history, and go and put a 2 at the end of that. Go to 2002, or 2003, and then let's go to a weekly. And this is why you don't just buy the dip, buy the dip, buy the dip. You can't even see it up there of what happened. I guess you can do your scrunchy best fit as long as you put it back. And look how far that fell. And both of us traded
And
through
there were
that. And
a lot of dips in there that you could have been buying. And again, back to the point where people were saying, "Oh, you just buy Cisco on the dip." Well, they were buying all the way down, and again, this eventually, really, it was down. I thought it was down more than that, but it was considerably. I think it was off like 90% from its highs.
yeah, and that was the quality. That was the Nvidia
Yeah.
of
Hmm.
what we have now. Cisco
Yeah, because you
was.
couldn't
So
imagine Cisco going away, and it didn't.
no,
But the stock, even though Cisco is still very widely used, it still hasn't gotten to the highs from all the way back here in March of 2000.
yeah. So that was just our, reminder to everyone to be careful, but be flexible, because you don't want to be left in the dust, and you don't want to be left holding the bag
Hmm.
either. So we can
Nobody
move
wants to get to the
forward.
party at the end because then you just get stuck cleaning up.
That is true.
Well, you were talking about SPY and RSP, so let's
Oh
uh,
yeah.
let's also do that contrast because you set up. Hey, look, we should stay above this marked high on market surge, but let's contrast this look with RSP, which when the market was maybe yeah, it started to look like it was crossing these highs, but then it's kind of come back below its 50-day moving average line. A little bit of a reversal today to the positive side, but still below that 50-day line.
Yeah, so the action that we see in a lot of the leading stocks right now look completely disconnected from this, right? You can see with that RS line, RS line on RSP always drifts down, but this past week it really fell down quite a bit. And how I measure that is really just visually the distance between its moving averages and the RS lines of the green line versus those two moving averages. And when that spread gets really wide, on the upside or the downside, that's where I pay attention. And this, what is this telling you? that is really a very narrow market, and the market is, let's pull up FNGS, I guess is the easiest way to look at things.
Hmm.
These are your mega, your 10 of the mega cap stocks, and those are in fresh new high territory, well above the 21 day and the 50 and the 200. And then the RSP is underneath, it's above the 200 day, but it's underneath the 21 day and the 10 day and the 50 day. That's just goes to show how really difficult it is. This is a hard game. Anyone who is just in the leaders is going, why even pay attention to this stuff? Hey, if that's working for you, man, keep doing it. But at some point, the averages really do make a difference. And as Bill always said about, most of the stocks are going to follow what the market does, and if you study history, that's the case.
Hmm. Well, let's go ahead and take a quick sector review. I'm going to
Sure.
go ahead and as we typically do, we go from the worst to the best. And of some of our extra sectors, NLR, the uranium and nuclear, this one was down 1.75% today. But is this? It's still above the 21-day moving average line. Is this a setup or is this trouble?
I do have a position in it. I don't think it's trouble, but it's also, you don't like that straight down, straight back up to new high ground type of. Uh, it's not normal and natural to just go straight up to new highs. So I would like it to, maybe doodle around. It doesn't have to do a double bottom and undercut this most recent bottom, but a little bit of time would be a healthier chart. Doesn't mean it can't go to new highs, but it'd be more normal and natural to just put some maybe a little bit more of a drift down. But this is still kind of the heat, the space, and my dad has been all over this. I think his cost basis is like 118. I'm so proud of him, and I know him and my mom watch the show. So great job, Dad.
Hmm. CCJ was one of the stocks that we talked about in IBD Live today, and Don
Hmm.
Vandenborg just killed it in terms of so much knowledge that he shared. He talked about using stochastics as a way to get into this potentially, as this comes down to the 20 level on maybe the 30-minute chart. So yeah, there's a lot of different ways in which this might be actually a setup instead of something that is problematic. Moving on.
Don was great on the show, and if anyone doesn't take IBD Live, maybe do a trial and just go and watch the Friday shows, because we always have next week we have Matt Caruso on, I believe, and we get some great guests on Fridays, and so much to learn from. And I think on your podcast this week you had Minervini and
Mark
Matt,
Minervini, right?
and
Hmm.
yeah,
Hmm.
so lots of
Hmm.
knowledge out there.
Yeah, absolutely. GDX, as much as we were all talking about the gold trade, we talked last week about this kind of little island top, which is not a good look for gold. Looking like it was trying to get some support around the 50-day moving average line for the miners. But it's, yeah, what do you think here?
I was trying it again this week because it was off of the 50-day. I'd been waiting for a pullback, and so when they happen, I try to give them a shot. I'm gonna probably just wait for it to get back above the 21 day. I think this looks just normal and natural. Like it doesn't feel like the gold trade is over in the very short term. That island top is bad in the short term, but let's look at the monthly chart on this, or actually even probably GLD is,
Hmm.
well, look at that. That doesn't look like it's, let's go to GLD. So this, I know it's a terrible closing range on that for the month, but it looks like something that wants to go a lot higher. But it's just a matter of getting a toehold in it. If I had a low cost basis, maybe like 100 and 50 or 200 on this one, I'd probably be using the RS line moving averages, on a weekly, to manage that position.
Hmm. XLU, let me go back to the daily. XLU was down about 0.7%, below the 21-day moving average line. Of course, there are a lot of AI adjacent plays in here because of the power needs of AI and the chips and the heat and the electric vehicles. There's so many things that are requiring more power. But yeah, this is still kind of coming off and not participating in this latest rally.
I would say look at the My Cousin Vinny version instead to
Utes.
get, yeah, and So this is more for the AI play because the other one is a mixture of true utilities, which are more like an XLP type of thing, along with the AI. So it just, I think you get cross currents with the
Mm.
uh, with the XLU, and this one is it's just base building. It looks like it needs a little time.
Yeah. And for those that don't know or not familiar, XLP is the staples, the consumer staples, which again, XLU, XLP usually tend to do better in markets where the institutions are hiding, right? They still have to be invested, but they're going to go into the staples and the utilities, some dividend plays, things that don't come off as much. They still come off a lot of times, but they don't come off as much in bear markets. But in good markets, who wants the slow pokey things? It's all about the heat and getting those names that everyone recognizes, your Nvidias and so on. So as expected, XLP not having a great day today. In addition, XLB. That's also the materials that we can see the relative strength line in a downtrend here and just getting worse below the 200-day moving average line. SMH had a rough day today. That could have been gosh, I know Broadcom, which I do have a position in that, was not really participating today. MPWR, that took a pretty big hit, came back off its lows, and I guess you could call it support of the 50-day moving average line. But man, that's still an ugly day. So maybe SMH feeling some of the heat from that. Nvidia, was basically flat off a little bit, and AMD, which is also a big player in there, was off its highs but still up. Anything to say about SMH?
It still looks very healthy to me. I'm looking to get into it
Hmm.
just because there's been so much rotation within that area. Like pull up A Lab, which I was so hot and heavy on, and then it fell out of bed and it tried to come up to the 50 days. So rather than playing the individual ones now, I'd rather do the SMH or a Soxel, which is a 3x version of it, um, because you don't know what the next news flow is going to be, where it hurts A Lab, but it helps Broadcom, or it helps Nvidia, but it hurts AMD, or TSM, or what have you. And unless I have an edge, I'd just rather go with the SMH, and I still think it's looking normal and natural, but I'm not in it, and I'd like to get in.
Yeah, I'm with you on that one. XLV, the healthcare, we talked a little bit about that last week. Looking like an upside reversal right around the 21-day moving average line. Um, XLRE, which again, a lot of income plays in there with the REITs that do offer pretty significant dividends. This is below its 200-day moving average line. Still looking to get a little bit of traction there. XLK, the tech sector, again, off its highs, finishing in the lower part of the range, and right at 300. KRE, which is our regional banks, those got really thrashed, especially with Zion Bank shares when it came out with its earnings. Still trending below the 50-day moving average line, kind of just following this 21-day moving average line lower, and now also below the 200-day moving average line with a relative strength that just is really getting ugly looking. ITA, aerospace and defense. This is looking pretty good. Got to highs earlier this week, and a little bit of a reversal here around the 10
Yeah, we
day.
almost added that to Swing Trader today, but pull up Boeing. I was just going through, the different ones in that space, and that's what kept us away from it. Just because it being such a you know, big part of that space that I think better to just pick the individual ones than have that be a drag on it.
Right. And then in terms of where things are falling in line, RSP that we talked about earlier, that was up 0.2%. XLI, the industrials, that was up about 0.25%. Relative strength not looking great, but it is just kind of hanging out there right by this top around 155.15. So not looking broken by any stretch, just a poor relative strength. XLF, the financials, this is below the 50-day moving average line, being weighed down by some of those regional banks, and also I think Berkshire Hathaway kind of that's been a little bit weaker below its 200-day moving average line, and that's a big component in XLF. But some of the individual stocks in here are looking okay. Your Morgan Stanleys, your Goldman Sachs. I do have a position in Goldman Sachs. And some of your big banks are not looking bad. SPY that we talked about. This is where that falls in our list. XLC. Now this is kind of a little bit of a push and pull because the two biggest players here are Alphabet, which has been having a pretty strong rally, and then you also have that contrasted with Meta that had earnings earlier this week and just really kind of fell out of the bed there. So
Yeah, Zuck, we'll stop talking about your stock. Yeah, I know it's down. You'll be okay. You're
you'll be
worth
okay.
billions,
You've got
dude.
enough money, right?
I'm sorry. Zuck calls me every time we talk about it.
Yeah,
Yeah.
just
So
because he's
with those,
listened to all your stuff, right?
yes, he does. He's got nothing to do. So with the Meta, let's go back there for a second. What I would suggest folks do is just look at the largest market cap weighted stocks, which obviously this is one of them, and then kind of see what would be normal and natural for them to where they should go, and you can kind of back into where the market should go. So this is a drag on it. Pull up Microsoft for
Hmm.
which had a disappointing week. It was set up really nicely, but they came back. But this still could come back and go up to the 550 next week and still be normal and natural. Whereas Meta, let's go back there, it's a broken chart in the short term. Like,
Yeah.
how does this resolve itself? It normally doesn't just go straight back up to 800 in a blink of an eye. It needs to form when a stock this big gets hit that much, it normally needs time. You're talking months to kind of resolve itself, but at least you've got the Google on the other side, and then
Mhm.
Nvidias and the other mega caps that are still hanging up, near new highs. But if we start having a lot of these fall this way, then you're more concerned about the market. One or two, not a big deal. Three or four, then you start getting worried.
Mhm. Q's fell about at the 0.5% mark. Again, 0.5% up. I shouldn't say fell. This is where it ended up, 0.5% up, and the QQEW, actually right around the same. So nice to see that the breadth on the Nasdaq 100 equal weighted is a little bit better. XBI, the biotechs that we talked a lot about, that just keeps on going up without me. Thank you
I
very
do have
much.
a position in that. Yeah.
Okay, lucky you.
No, I mean
XLE.
just.
I'm just kidding. No, and again, I sold it because I was writing about it last week, and I just
Oh,
didn't
okay.
get a chance to buy it back. So I'm on
I
the
think
outside
this
looking
is
in.
the place to be looking, the XBI, but not the individual bios unless you have a stomach made of steel, man, because they
Right.
can, like, on bad news, they can fall a lot, 50% or more. So whether it doesn't have to be this ETF, but I would look at other ones as well. I mean, this is one that I like, but
Hmm.
it's just the one I'm used to.
Yeah, there's a few to choose from, including IBB, and you can just look at the holdings, and it gives you a sense of where they are. And if you want a little bit of leverage, there's always the BIB, which is 2x of the Nasdaq Biotechnology Index. That's the IBB, but doubled. So yeah, that one looks strong as well. XLE Energy, gosh, it's still a lot of back and forth action on the energy stocks, and this isn't just Chevron and Exxon, the two biggest components making up 40% of this that it's causing this. If you look at RSPG, it looks very similar, and that's the equal weighted energy sector for the spiders. FNGS, as we talked about, that was up nicely with a 0.5% move higher, and IGV, the software, a lot of the computer software enterprise, and just the cybersecurity, a lot of those looking decent. CIBR was added to Swing Trader today. This is up 1.3%. So yeah, software looking interesting. XLY, this was helped a great deal by Amazon that we're going to cover in a little bit. This was up 2.6% for the day. And then two more.
And I do have a position in Amazon.
Okay, let's look at IBIT, which is the Bitcoin Trust. That's trying to get back to its 50-day moving average line. That was up about 3% today, and taking the taking the
Can
top
can you
spot,
stop?
ARKK.
Go back to the IBIT for a second, because I saw some people that I really respect making comments about volume on IBIT. Dude, don't do that. If you're going to use volume, which I don't use, but if you're going to use volume, don't use it on an ETF, because you would have to use all the volume. This is representing something else. This is representing what Bitcoin is doing. So you would, to interpret the volume on it, you'd have to look at the GBTC. You'd have to look at anything that is also um, doing mirroring Bitcoin in any way, shape, or form, or leverage versions, as
Right.
well as the futures market, and tally them all up to understand and interpret the volume. Please don't use ETF volume. That's my public service announcement. Please. It's so
Right.
silly.
Yeah, because I mean, yeah, as you said, there's a lot of different ways in which people could be playing Bitcoin, but you just don't know. Oh, is this the favored way? Yeah, and also with the hedging, that makes it even more complicated. The way people use hedges sometimes. But taking the cake was Kathy Wood's ARK Innovation Fund, ARK-K. This one was up about 3.85%. Been kind of just tracing along its 21-day moving average line, but still well above the 50-day line. Um,
And I do have some of that as well.
okay, and let's go ahead and talk about Amazon. As you mentioned, you have a position in all three of the stocks that we're going to be talking about today. But Amazon, big move, gap up on earnings, off its highs, but still, I mean, it's hard to complain about a 9.5% gain unless you were buying it at 250, in which case you're like, okay, I'm down a bit on this, but not in a disastrous way. How do you play this?
I bought some early on, but just a little bit, and I was going to be doing a TWAP throughout the day. But then when it pulled back in enough, I said, you know what, it makes more sense for me to sell those shares and put it on Swing Trader and wait the 30 minutes, knowing that this was a potential risk of closing near the lows, or even, we might get kicked out of it if it comes all the way into the pivot, the 238.85. That's probably where we'll, back out of it. But with gap ups, you never know how they're going to play themselves out. Are they going to just gap up and can keep going? And so you either let them all go, or sometimes you try to get a toehold in it and see if it can go sideways a little bit, have an upside reversal, to add to it or to initiate your position. It's a personal preference. When you look at something like this, you'd say, well, why would you want to buy it on a gap up? It's extended now. Well, it's a 2% extended out of that base, but there's less risks now than there was yesterday. Even though
Mhm.
it's extended, it was a much better price yesterday, but you were stepping in front of the potential freight train of it being just like Meta and having a gap down, or some of pull up, what was it, LRN? I think that was one of the ones we were talking about earlier this week, that the gap down on earnings. Like, when you buy something in front of earnings, that could happen. Yeah, it could have gone up to $200 as well. But now let's go back to the Amazon. When you have the earnings behind you, you have less risk there, but then you have that gap risk, right? So it could
Mhm.
close the gap and then go back up, and then you have to be willing to buy it back. So I would say folks should study these, and find the right method for you. It's not going plowing in with your full position on a gap up. It's kind of, you just slowly get your toehold in there, because sometimes they never look back. Let's go to the monthly on this one for a second. What I find interesting about this one is it's kind of been dead money for a long time. I know it's gone from, the left side of the chart all the way up to the right side, but it's really dead money. And why I say that is, look at that RS line versus its moving averages. It's pretty much, it never really stays a leader. It's a general uptrend, but kind of um, marking what the S&P is doing, with a little bit more of an up move than that. But it hasn't had that real disconnect from its moving average. Like, let's look at Nvidia for a second, which is kind of the poster child for a stock that's been a true leader. Look at the distance, the white space between your green line and those moving averages, truly leading for a long period of time. So this could happen. Doesn't mean it's going to happen. Could happen with Amazon. Let's go back to Amazon on the monthly, where this is just the very beginning of it. Now, what folks would probably say is,
And
well,
look, it
boy, that,
did have Amazon had that look back here, right?
yep,
So yeah, it's not like, and certainly a lot of people could say, oh well, this is a mature company, it's a huge company. Certainly in 2014, there's no way it can make a move like that. And look, it did.
exactly. And they're diversified. It's because they've got their retail space, but they also have their Amazon Video
AWS,
and the AWS is like the biggest, like
right?
that is what everyone is truly trading when they're trading it. But then you've got this other stuff to buffer out if AWS kind of has some issues, because you're really
Mhm,
trading AWS. I mean, at some point they're going to probably break the company up in between their different divisions, but we'll see if that
mhm,
ever happens. But we talked about on the show this morning, Apple back in 2004, when it started its move, it had a relative strength of around 50, 55 or so at the beginning of that move. So when they're dead for a long time, you're going to have a low RS, yeah, out of that little cup with handle down there. And, you know, in things changed. That it was the very beginning of the move, and then it ended up being one of the monster stocks of greatest stocks of all time, frankly. And so that could happen with Amazon. We'll see. We'll keep an open mind. Um, and yeah, well, if we get stopped out, we get stopped out. I can't hear you. Are you saying how great I
I
am?
think, yeah, I was, yeah. So I just didn't want
Well,
everyone
thank
else
you.
to
I
know.
appreciate that.
So
Okay.
here's Cloudflare NET, strong breakout again on earnings. More of these earnings are getting behind us. This was a big week for earnings. We still have another big week next week, but talk a little bit about this breakout and how to play it.
Yeah, so I do have a position in this. I bought a token position in it yesterday in front of the earnings, which was on the risky side of things, but I wanted to have a little bit of a toehold in it so I could add to it if it had a good reaction, or if it gapped down as much, it was up 13% or whatever. If it was down 13% or 20%, I wouldn't have gotten that hurt because it wasn't a material size coming into today, but it did allow me to have some lower cost basis. And this is a very clean breakout. This is just a cookie cutter, flat base, breaks out. You have a clear expectation. It should stay above the 230 um, area.
Mhm,
If this is for real, and let's go to the monthly on this one. What I like about this is it was a monster stock when it came public. I mean, that was such a big move, and then it fell out of bed for a long time, but it did hold above. Thank you. It did hold above, well above its original IPO area when it came down, and it's just this is a giant cup that it's breaking out of, and I think it has a long way to go, but we will see. It's not This one is not for the faint of heart because it can get wild, but
mhm.
it looks good.
Yeah, very good. And let's round it out with Robinhood. You and I both have a position in this one.
Mhm.
Um, this has obviously been one of the leaders of this rally. You see that strong relative strength. It's had its breaks, along the way, and most recently here, but it's almost right back up there at highs. Earnings coming up in about next week.
So this to me looks like a mini cup with handle. Now, Bill wouldn't call that a cup with handle because it's too short, but I'm calling it a cup with handle in spirit, where now we have a clear expectation that it should stay above yesterday's low. Now, you've got the big risk event with the earnings next week, so some people might not want to trade it at all until the earnings are out. But then if there's a good reaction, this will be 165 plus. And if it doesn't work out, it'll be $100 minus. So you've got to adjust your size accordingly. But I think this is one of the true market leaders of this part of this bull market right now, and is very reminiscent to me of Schwab back in the 90s. And let's go to the weekly on this one. We always get that question if Bill were around, what would he be trading? And I think we would both agree that he would be in this one, and probably in a very big way, because he would kind of go back to the well of, he would say, oh, wow,
Mhm.
I traded Schwab and that was one of his biggest winners, back in 98. And let's just go to Ah,
Nope.
you read my
I can't. I
mind.
can't. I can't. Can't go to Hood back in 1998, but we can do Schwab, and this is actually when it came out of its. Uh, what at the time I was like, why is Bill calling this a cup with handle? It took me a long
I
time
thought
to
he was
recognize.
messing with us,
Right?
right?
Are
Like
you
it's
sure
like,
that's not a faulty double bottom? Because of how deep this handle was, a 27% deep handle. But man, it came out of this and just didn't look back. This was a 400% move plus in 6 months, and was phenomenal. And one of the things about this was, look, Schwab, if you looked at the other brokerages at the time, Schwab looked different. Schwab looked like AOL. It didn't look like
hmm
the other brokerages because it was, revolutionary in becoming an online broker, and that's what was, really behind this move because it was all about the online moves at that
yeah, and
time.
it seems like that's what, Hood is just doing that same thing all over again. And he was able to top tick that, on the way out, which is not an easy thing to do. And it is worth noting that out of that cup with handle, that unusually looking cup with handle down there, that was the bear market of that 33% bear market that he didn't sit through. He
Right.
got out, because that's what you were supposed to do, but then got back in and got back in a big way. And that's something that folks should study over this weekend.
Yeah, and it's one of those, times where again, at the time, I mean, there was so many concerns with long-term capital management taking the entire market down with it because of, uh, you know, how many fingers it had in so many pots. And I mean, you also had the Russian, the Asian, currencies. There was a lot of problems at the time. But yeah, so back to Hood. Uh, that's kind of a precedent there, looking at Schwab. But Hood, you're saying is something that's potentially setting up, and earnings coming up next week. But we'll see how this handles it. And again, both you and I have positions in this. Mike, are you ready to take over? We're running a little late, but
Yes, yeah, I will be fast with these. I guess I blame it all on you. Like I'm always
yeah,
to the point. I never go off on tangents ever.
yeah.
So
The fact that you call your podcast "Webby Rambles On," that was just satire, right? It's because of your
it was because
conciseness.
that's
Yes,
what I do. Yes.
yeah. So
Okay. So here's SPY. This is our Bob Weir. Take a step back, and we're just looking at this on a weekly candle basis to see, is there anything unique here that it's telling us? Is it doing anything abnormal to really worry about? It's a stalling candle, right? It goes up in a new high ground. We've got a negative body, meaning that it closed lower than it opened, and you've got a longer top wick, meaning it traveled up there but then closed down. That's a bad looking candle. Is it a horrible looking candle? No. And why is it not a horrible looking candle? Because the spread isn't that wide. These happen on the way up. If this was the only thing you looked at, your expectation would be lower next week, but not materially lower. Like if you look at this, go, oh, normal and natural would be somewhere in the middle of last week's candle. And that's what you want to do as we go through this. You're just painting a picture in your mind of all these different pieces of what would be normal and natural. And then you walk away with a better picture. So on the NASDAQ, much stronger, right? And why? Our close was above our open for the week. You can tell that by the blue candle versus the pink candle we had on the other one. You kept that gap up. On the negative side of it, you do have a top wick that is much longer than the bottom wick, but really that bottom wick is the true candle wick goes all the way down to the close of last week. So with that in mind, it actually looks better, but you have the gap in there. So let's just look at IWM, see if there's anything there. Now, not so good, right? Because I was getting all hot and heavy on this one, but it is proving to be a very difficult one to trade. And this looks significantly different than the other ones. So now let's move on to our regression. This was the original regression lines that we were using with the May 12th and the July 22nd or 23rd endpoints, and that is dead because as of this day, the October 10th, it fell out from those regressions and stayed underneath them. Tried to come back up in here and got turned away a little bit. Those it was really dead a couple days after that, let's say by the 15th, you had to put that one to bed. Same thing with the NASDAQ. Now, for the IWM, we started switching to different dates. And with that one, we were using this time where it undercut the 50 here on looks like what was that, August 1st, and then we went out 50 days from there, and that point was the October 10th, right? um and here it's back, it tried to go up through the 0.75 minus 0.75 standard deviation, which is the green dash line. The way I interpret that is when it goes up through there, you should have shot up to your what I call home base, or your line of best fit, your regression line, the white line. And it backed away, so that's actually acting weak, and your high is now underneath your one standard deviation. So IWM is looking on the weak side now. Let's use those same dates, but do it on SPY and NASDAQ, and you'll see a little bit of a different picture. This is acting a little bit more normal and natural. Let me blow this up. And again, we are using that August 1st starting date. This did exactly what you would have thought it would do. Is as it went through the 0.75 or the green dash line, it went straight up past your white line, up near your red dash line, which is half a standard deviation above this. Forget all this jargon. Just what happens is it wiggles and wobbles and it wants to mean revert. Mean revert means go back to the white line. That's why I call it home base. If it's in a trend that's healthy, it wants to go to that white line. When it gets too far above it, it wants to come back to it. Gets too far below it, wants to go back up to it. So what it's doing right now is normal and natural in hugging that new regression that we're using. And then the same thing with the Nasdaq, but a little bit stronger. So that's telling you now we have a couple things that are telling us that Nasdaq is stronger than SPY, because this one went up through your point, your half standard deviation above it, pulled back into your white line, but is still up there. And it can really live in this kind of channel in here for a lot longer than you think. So we'll see how that plays out. Now we will move on to our 50% retracements. These will be quick. I was still using the October 10th high and low. We're on the northern side of that. So all is good on NASDAQ and SPY. They're both well above it. IWM, we had a little bit different dates. We were using the October 10th low and then the high on the 15th. And that's just right around the midpoint right now. So we really wanted to be living up in this space to be healthier. Now we'll move on to our lines in the sand. And now we've put a new line in there, and this on SPY is 673.94, which is the high of this area that it broke out of. And if it comes into that, it will line up with our 21 day. So we want to stay above that. And then next would be the low of October 10th. The rest we'll worry about if we get there. NASDAQ, same basic thing. The high from the 10th, it becomes our line, and that's lines up well with the 21 day. And we'll look at IWM. In this one, there's a lot of lines you could put on there, and probably the first one is the low from the 22nd, but really the material one would be the low from the 10th. Then we are going to do this thing where I look at all the moving averages from very short term to very long term. And I just use the Fibonacci numbers. So, 3, 5, 8, 13, 21, and so on, to see are they stacked properly or not? And when they're stacked properly, you want to lean offensive. When they start rolling over, you want to start getting concerned. That's why I was getting concerned over here, because my instruments were telling me to. Now that we're getting back above it, we're saying, hey, don't be as concerned. The trend is your friend and all that good stuff. And so same thing on the NASDAQ. And let's take a look at the IWM. Not so good, right? So now your shorter term moving averages are underneath your kind of intermediate ones. And let's look at RSP. I haven't looked at that one yet. And that's a bit problematic. So this is your average stock. So your for each one that your shorter term moving average is underneath a different one, that's concerning. So let's look back at like the Qs and this is what you want to see. Each one is stacked above it. Then for the simplest view, if you're saying, all this garbage, why do I have to look at that? That's why we have this. This is our favorite chart. And I think this is Allie's favorite chart. We did get a new picture of her little baby dressed up for her first Halloween. So that was wonderful to see. And she's doing well, as we've heard. So that's great. SPY with just the blue line on there. The blue line is your 21-day moving average. When you do this, you just want to keep it simple. Is your low above it or not? Is your high underneath it or not? Our low is above it, and it looks very healthy. And let's look at the NASDAQ. Same thing there. Just looking at that distance, and we'll look at the IWM, and not so much, right? Because now we're back in that chop zone. When your low is not above your 21-day, you're kind of in your chop zone. And let me stop sharing with that, and I will go over and share the other one. Um, I'm making up some time here. I'm trying to be fast.
Yeah, no,
Let's
you're doing
see.
great. I'm trying not to interrupt and get in your
Okay.
way.
Okay. There you go. So we will go to the Webby RSI, which is the little thing at the bottom. And what this is just, if this is your first show with us, welcome. That it's measuring the distance of your low versus your 21-day exponential in terms of ATRs. So this is, it'll only show up there in blue if you actually have some distance there. So like with the IWM, there's no histogram down here because your low is not above it. So let's go back to SPY. So SPY, this is healthy, but you would be fine with it actually getting stronger. You want to see a wall of blue like we had over here during this run. Now let's take a look at the NASDAQ. I like this one here. It's getting much stronger. And if you went back and you looked at what happened in that 1999 timeframe in October, it had this wall of blue, and it got a lot higher than what you would think. So I know some people are using some indicators and saying that you're stretched and it's a selling point. But the way I interpret this is at this point, you actually do want this strength because we broke out, and you don't want to just meander. You really want to kind of have a very strong move. It doesn't have to be as strong as 99, but something along those lines would be healthy in my opinion based on my observations. So let's look at the Bob Marley um, off high one. And this is just what you want to do is just focus in on the green area. And the green area is saying that your low is within 4 ATRs of your high. And then once, as long as it's green, then you want to kind of interpret, is it acting normal and natural? So here's SPY when it came down in August, came down around, let's call it just generally 3.5 ATRs off the high. So the next time you have a pullback, you want to see, is that in and around the same area? That would mean the character is still the same. And that's exactly what happened here on the 10th. A little bit worse, but still in that same ballpark. And then we bounced up. So it's just a way of measuring the character of the index. Is it acting normal and natural? And the same
Doesn't
thing
feel
here.
good in the moment, you know.
Oh God, it feels terrible in the moment.
Right. Even though
Every
it's still
time it's
green and it's like, oh, this is normal, it still, doesn't feel good in the moment.
oh no, it's terrible in the moment. I think every time it's down there, I'm thinking 1987, and so was Bill. Like
Yeah.
that's and that's kind of keeps you in the game because you always like kind of worry and everything. And worrying is a healthy thing. Well, maybe the psychologists out there
Let's
would
say
say it's
everything
not.
in moderation.
Yeah, well, I'm not very moderate with anything. And here's the IWM that's a little bit of a different position because it's coming up from the dead. And let's look at the RSP. So this is your average one. And with the pullbacks here, you can see they were a bit more severe. And this came down a little bit over 4 ATRs that time. This time was a little bit better there. But so, what does all this mumbo jumbo mean? What it means is, if you're just kind of summarizing, we went through new highs. Go back again. I said it at the beginning of the show. Go back to last week's show. Fast forward to the end. We have some dates on there in a little Excel spreadsheet. Go back and study those dates. What the two of us found is when you break out of one of those ranges, that you tend to continue in the initial direction. Down, continued lower, up, continued higher. So everything that we're looking at tells us that we should be moving higher. Is it scary? Yeah, it's really scary, man, because the RSP isn't looking that good. IWM is giving us trouble again. We're in the middle of all this new stuff. They never said they were going to make it easy. So what do? You follow your indicators, trade your way. I lean heavily on this show and on the IBD Live talking about swing trading. I also position trade. If you position trade, take a step back, look at the weekly charts. Are the weeklies looking normal? Are your RS lines above your moving averages on your weekly chart, using my quicksand Grateful Dead? If so, you can hold those. So you don't have to swing trade, just because we talk about swing trading a lot. You can just position trade and just interpret the market. If the market's really in trouble, then you need to start, you know, backing away. But right now, go back, study 1999. It feels very similar.
Yeah. Well, hey, Mike, appreciate all your thoughts. And to everyone out there, hope you have a great, safe Halloween. If you're trick or treating, have a great time with that. And it's going to be, I think, in my area, we have a lot of man caves. So because the Dodger game is going to be on during trick or treating time, prime trick or treating time, I
Is
think,
it?
yeah. So I think,
Who are they
yeah,
playing? Who are they playing? This is the
uh,
World Series, right?
it is the World Series, yes, the
Okay.
Toronto Blue Jays. So I'm sure there's going to be a lot of stops along the way in the neighborhood with TVs on in the man cave garages in the neighborhood. So yeah,
Do they
well,
yell goal
yes, yeah, exactly.
when they hit it? Uh,
Goal. Yeah, that's how they.
Goal? Okay.
Every baseball game, you're gonna hear that at some
My
point.
dad right now is yelling at the screen. They think you're serious.
Right, exactly. Well, thanks again, Mike. Hope you have a great weekend. And thank you, everyone. Especially, gosh, I got to tell you guys, I really get amused by all these YouTube comments. What a great community you guys have in there. Everyone's like, oh, hey, how's this going? How's this doing? And just wonderful watching some of it. I get distracted sometimes, but it's fun to watch. So have a great weekend, everybody. Have a good, happy Halloween. And we will see you all on Monday for our IBD Live and on the Stock Market Today video. Don't forget, if you haven't checked out Don Vandenborg's um, uh, uh, appearance this morning, you can go to investors.com/IBD Live for a trial there. Also, Mark Minervini was on the podcast a little bit earlier. We spent a lot of time talking about breath. So those are some of the things that you can take a look at. Have a great weekend. See you next time. Bye now.